Imagine waking up on a Tuesday morning in Sydney and instead of dragging yourself to a job you tolerate, you walk to the kitchen, make a coffee, and check your phone. Sitting in your account is a dividend payment that just covered your mortgage. You did not work for it. You did not trade hours for it. Your money did the heavy lifting while you slept. That is what life on your own terms actually looks like in Australia, and the truth is, it is not reserved for trust fund kids or tech founders. It is a maths problem, and once you know the number you are aiming at, the whole game changes. Most Australians are stuck in a cycle they never agreed to. You earn, you spend, you pay tax, you survive, and then you do it all again next fortnight. The average full-time worker in Australia is now pulling in around $106,000 a year before tax, according to the latest figures from the Australian Bureau of Statistics. Sounds healthy. But after tax, after rent or mortgage, after groceries that somehow cost twice what they did 3 years ago, most people are left wondering where it all went. The problem is not your income. The problem is that your income stops the moment you stop working, and that is the trap I want to help you escape today. But while long-term passive investing is about building your retirement nest egg, some of you are also interested in the active side of the markets, to understand short-term price movements and actively managing your trades. That's where today's sponsor, Mitrade, comes in. Mitrade is an award-winning licensed CFD broker founded in Melbourne back in 2011. They give you access to over 970 global instruments through CFDs of Forex, gold, oil, indices, and shares, all from one platform. They offer zero commission on all CFD trades, though spreads and overnight funding fees do apply. One standout feature is full TradingView integration built directly into the platform, so you get advanced charting with over 80 technical indicators without paying extra. If you're curious but not ready to commit real money, Mitrade offers a free demo account with $50,000 in virtual funds. It's a way to explore the platform and see how CFD trading works without any financial commitment. I do need to be upfront. 74 to 89% of retail investor accounts lose money when trading CFDs. CFDs are complex, high-risk instruments and may not be suitable for everyone. Only trade with capital you can afford to lose. Links in the description and pinned in the comments if you want to check it out. Now back to that Tuesday morning coffee, let's figure out exactly how much you need in your account to make it happen. The framework most experienced investors use is called the safe withdrawal rate. The classic version is the 4% rule, which says you can pull 4% of your portfolio each year, and it should last you 30 years or longer based on historical market returns. Here is the simple formula. Take the after-tax income you want to replace and divide it by 0.04. That is your number. That is the size of the investment portfolio you need to never have to work again. Let me walk you through it by income, so you can see exactly where you sit. Let's start with someone earning $60,000 a year. After tax, that takes home around $51,000. To replace that with passive income at 4%, you would need $1.275 million invested. That sounds enormous, but spread across a 25-year working life, with consistent contributions and the magic of compounding, it is genuinely achievable on this salary. Investing roughly $800 a month into a diversified ETF portfolio, earning 8% annually gets you there. Now let us move up to $80,000. After tax, you take home around $65,000. The portfolio you need is $1.625 million. Bigger number, but the same principle. The earlier you start, the smaller the monthly contribution needs to be, because compounding does most of the work in the final decade. Then there is the average full-time salary in Australia, sitting at around $100,000. After tax, you're walking away with roughly $76,500 a year. Replacing that with passive income means building a portfolio of $1.91 million. Most Australians hear that number and immediately switch off. They think it is impossible. But here is the reality check. Your superannuation is already part of this calculation. If you are 35 years old earning $100,000, your super contributions alone, growing at long-term market returns, will likely give you well over $1 million by the time you hit 60. Now let us go higher. If you earn $150,000, your take-home is around $107,000. To replace that, you need $2.675 million invested. At $200,000, take home is around $137,000, and you need around $3.425 million. And if you are one of the higher earners pulling $250,000 a year, take home is roughly $165,000, requiring a portfolio of about $4.1 million to fully replace your income with passive cash flow. Big numbers. But here is what nobody tells you. You do not actually need to replace your full pre-tax salary. You need to replace your lifestyle. There is a massive difference. Most people, once they stop working, no longer pay for commuting, work clothes, weekday lunches, expensive convenience food, or that second car. They are not contributing to super anymore because they do not need to. Their tax bill drops dramatically because investment income, especially fully franked dividends, is taxed far more favorably than salary income. So in reality, your true freedom number might be 30 to 40% lower than the figures I just gave you. Let me show you what that looks like. If you earn $100,000 now, but your actual annual lifestyle costs $60,000, your real freedom number is 1.5 million, not 1.9 million. That is a $400,000 difference. That could be 5 years of your life back. 5 years you do not have to spend chained to a desk. This is why tracking your actual spending is more powerful than tracking your salary. Your spending tells you the truth about how much freedom costs. Now let's talk about how to actually get there. Most Australians building serious wealth are doing 3 things consistently. First, they are maxing out salary sacrifice into super up to the concessional cap. Second, they are dollar cost averaging into low-cost index ETFs outside of super, so they have access to capital before preservation age. Third, they are aggressively paying down high-interest debt before anything else, because no investment reliably beats the guaranteed return of clearing a 20% credit card. The franking credit system in Australia is genuinely one of the best deals for retirees in the world. When you receive a fully franked dividend from an ASX company, you get a tax credit attached because the company already paid 30% corporate tax. For a retiree on a low taxable income, that often means the franking credits are refunded straight back to you. The grossed up yield on the broader Australian market is currently sitting around 5 to 6% when you include franking, which means a smaller portfolio can produce more usable income than the headline 4% suggests. Here is a simple exercise to do tonight. Pull up your last 3 months of bank statements. Add up everything you actually spent. Multiply that monthly figure by 12. Then divide that annual number by 0.04. That's your real freedom number. Write it down. Stick it on the fridge. Make it the screensaver on your phone. Because the moment you have a specific target, your brain stops seeing money as something to spend and starts seeing it as ammunition for your freedom. The Australians who retire early and on their own terms are not the ones who earn the most. They are the ones who started early, kept their lifestyle modest while their income grew, and let compounding do the work. You do not need a finance degree. You do not need to pick winning stocks. You need a number, a plan, and the patience to stick with it through the noise. If this video helped you see things differently, hit the like button and subscribe to the channel. Thanks for watching, and I'll see you in the next one.